Hello everyone and welcome to this lunchtime masterclass session hosted by Family Building Society. I'm Nick Cheek, Managing Editor at Mortgage Solutions. In today's masterclass, we'll be discussing the opportunities in the later life lending market. Now, just because it's Halloween today, getting older and needing extra funds shouldn't be spooking your clients. And although challenges exist in the market, which we will discuss, older borrowers shouldn't fear using the equity they have built up in the property. That said, the later life market, like so much of the mortgage sector, is in a state of flux at present. Recent figures have shown that lending is down this year, but it should be noted that this is on the back of a record 2022. In addition, there was a recent probe by the FCA into the market, which found that standards need to be raised in certain parts of the sector. However, the report also noted that improvements had and were being made, and that advisors and lenders in the later life sector had embraced consumer duty. And one of the keys to that improvement has been education, which is very much the thrust behind this session today. Among other aspects, we'll be exploring overcoming challenges, examining different income and how it can be used, and the importance of using standard mortgage products rather than rushing immediately to equity release. I'm joined today by Darren Deacon, Head of Intermediary Sales, and Nathan Waller, Business Development Manager at Family Building Society. Now, there will be a Q&A at the end of the session, so we'd really appreciate your questions. If you want to submit a question, click the question tab on the left-hand side of the screen. And so without further ado, I will hand you over to Darren and Nathan to kick off the session. Thank you, Darren and Nathan.
Okay, well, thanks very much, Nick, and good afternoon to everybody. My name is Darren Deacon. I am Head of Intermediary Sales for Family Building Society. And as Nick said there, today we have our East of England BDM, Nathan Waller. Between us, we will look at the opportunities in the later life market and ways that Family Building Society can assist. So, as you can see there, we feel that education is key. This is especially felt in the later life market. So by the end of this presentation, I hope that you'll have a greater understanding of the size of the sector and also see how we can assist with utilising passive incomes, offer bespoke manual underwriting, and just explain how a standard mortgage can be used as an alternative to equity release or some other lifetime mortgage. So, Family Building Society, just a bit of background of ourselves. We've been around for over 125 years, and we are known as a later life specialist. As I said there earlier, we manually underwrite every single one of our mortgage applications. So therefore, each case that comes to us usually has a story attached to it. So a little later on, follow myself, Nathan will cover our USPs and go into a bit more detail about ways that we can help with your later life customers, maybe bring that to life. So just moving into this slide here, I just wanted to highlight the market potential. And as many of you know, we have an aging population. So if you can, just focus on the green shaded areas. You'll see the top shaded area. And what that shows is the biggest population growth in 2020 was between the ages of 57 and 72. And what it also shows is the green shaded bit underneath is that the largest growth area is predicted to be by 2030 between the ages of 75 and 87. So as we can see, it definitely is an aging population. And it's also interesting to note that there's going to be there are around 21 million people who are over the age of 55 currently in the UK. And this is set to rise to just shy of 24 million by 2030. So hopefully this slide and that graph will demonstrate the size of and the potential of the market, as many of these people, obviously going into their 50s, 60s, 70s, and even to their 80s, will still need a mortgage or some other form of borrowing. The next slide also, again, illustrates the opportunity. Now, if you can just see at the bottom there, there's a circle, and that circle in red. And that just emphasises the biggest expectation of age growth by 2045. And that is for people going into pension age. So again, demonstrating the size of the sector. Now, we know that COVID had an impact on lending in general, as Nick alluded to, and we know that later life lending was not immune to that, certainly to people over the ages of 55. But we did see this bounce back in 2021 when there were more than 187,000 new mortgages with total borrowing of over 28 billion. And this actually saw the highest volume of lending to over 55s since 2014. And what we also see with recent data is that 4 out of 5 mortgages for older borrowers is done via a standard mortgage. So often was the case that people believed that a lifetime mortgage was the only available option. But in 2023, we've seen a stagnation or even a reduction in these sale of products. And UK finance data shows that over 30,000 standard mortgages were advanced to older borrowers in Q2 of this year, as opposed to slightly over 7,000 lifetime mortgages. So you can see the disparity between a standard mortgage and a lifetime mortgage. And what you'll also note from that as well is that there were only 285 RIO mortgages that were sold in this period. And I will touch on RIO mortgages a little bit later on. But there's one stat there that I just wanted to point out to you, is that later life borrowing, or at least mortgages that extend into retirement, now makes up 60% of all residential lending. So a big opportunity there for you business writers. This slide shows the volume of lending specifically to the later life ages range. So you can see, hopefully at the top there, that the highest level of mortgage borrowing in the later life space were people between the ages of 55 and 59. It then drops over the next 2 age categories, but it jumps up again for the age range of 70 plus. This slide shows the customers' ages at the end of the mortgage term. And the largest area of where people are finishing their mortgages is between the age of 65 and 74. So again, demonstrating the requirement for later life lending options where borrowers have perhaps needed to extend their mortgage term. Maybe this is due to a major life event, maybe through a death, divorce, or loss of job. So this necessity to extend that mortgage beyond what we would normally class as their standard retirement age. So, as I mentioned earlier, we talked about, we looked at RIO mortgages, and we saw how RIO mortgages in particular were down in the general later life space. So in fact, these were launched by the FCA in March 2018, and whether you know or not, but sales have been very, very poor on this particular product. So poor, in fact, that the FCA predicted that by 2021, there would be at least 21,000 RIO mortgages being sold each year, when in actual fact, there's only been around 9,000 in total that have been sold to date, as I say, since March 2018. So as a later life lender, we have a RIO product, but the main issue with them is where you have to apply the death stress. So this is the requirement to show that the mortgage is affordable in either name should one person pass away, and this is often the reason why these cases fall down. But one consolation to us is that many of these RIO cases, what they will still fit as a standard residential interest-only mortgage. So we're happy to look at these as we do in great volume. We looked at areas where people and examples of why people will be looking to take a mortgage into later life. As I say, major life events, as I said before, divorce or death. But there are other reasons why people want to take a mortgage into retirement. They're given there on the slide. And I think the thing to take from that is that many people are not ready for the traditional pipe and slippers. They want to use their homes to benefit their families and even their own lifestyles. And again, there's many reasons and many, many options that we can provide for these later life customers. So to put it into context, there is a staggering 700,000 interest-only mortgages and 220,000 part and part mortgages that need repaying by retirement age. So again, emphasize the opportunity in the market. Many of these people obviously need the correct advice. So in fact, mortgage debt for the over 65s has increased from 20 billion in 2017, and it's predicted to nearly double to just under 40 million by 2030. So lifetime mortgages were often assumed to be the primary vehicle for borrowers over 65, but as we know, they're not always right for all. And the final slide for me is it's from Criteria Brain, which shows the top 25 searches, and you can see that 2 of those are for max age limits. So again, it's a reflection of the market that many, many advisors are turning to Criteria Brain with customers that have a need and requirement for that later life lending. Okay, that's all from me. Thank you very much for listening. I will now hand you back over to Nathan. He will explain some more specifics of other areas where we can assist.
Thank you, Darren. Some really interesting facts and figures there, and I think that really does show how big a market this is. And even really, if you kind of go back to one of the previous slides where we were talking about the reason that's driving later life lending, quite an interesting statistic that I saw from This Is Money, when you kind of go back to the bank of mum and dad and the bank of granny and granddad and things like that, is they're looking at bringing in about £8.1 billion to the market this year, which is huge, a huge amount of figures, a huge amount of money there. And it really does again show how this type of market is growing. It's not just later life for the customers and their needs for their own mortgages, but it's also providing assistance across the generations, really. And really, again, it's really that joined up approach between the brokers, the clients there, and their families. So let's have a little bit of a talk in regards to the challenges. Now, from a lender's perspective, it has been a very, very tricky time. As we're all probably aware, purchase business has slowed, and really keeping existing customers on our books has really been key to kind of keep the business flowing and things like that. And where we really needed to look at attracting clients on remortgage business, keeping them on our product transfers, we're trying to be as flexible and understanding as we possibly can to really kind of attract that additional business. And where we are looking at rates, ultimately we've been trying to do what we can, and every lender really has been trying to do what they can to assist you and your customers. But the swap rates really have had a huge impact on the pricing, which has really kind of helped drive client behaviours and what they're looking for and what they're looking to do as well. And as you as the broker will no doubt have noticed, affordability has got tighter in general, with the increase of cost of living, with the increase of cost of funding. ONS data is being amended and changed. The background stresses that we as a lender have to apply to make sure the mortgage is affordable, not just now, but also in the future, has obviously gone up. So that's one of the reasons why you are seeing that affordability has become tighter with lenders, and why you've seen a lot of fluctuations in rate increases and product changes over the last few years, which we are now beginning to see drop down and things begin to get a bit more calmer for the meantime. But really that kind of falls onto the customers. They've been concerned, they've been worried about it. Ultimately, they are the people that are paying this mortgage, and I think there's a little bit of concern from them as to what they're going to do now and also moving forward to keep those mortgage costs cheap enough for them to be affordable, or to maybe change their situation, changing to things to interest only, maybe extending to terms, maybe needing a bit more of a manual approach to their individual case and circumstances, because where it was just as simple as putting a case through an affordability calculator, or maybe just putting it through a DIP process and the computer saying yes and no, we're really needing to look at these cases in a bit more of a manual approach to really understand what is going on, and also what's going to be happening in the future, to really maybe extend that term or to go into the later life market and that sector, or look at using what they've built up over the last few years, and where some lenders may only kind of cap out at 70 or 75. That's not necessarily the right approach for everybody. And we'll come on to our policies and criteria and the terms that we can look to assist people with, which kind of shows really where we fit in. But really, the biggest thing to overcome these kind of challenges in this market is the education of it all. More people are lending into retirement, as we've seen from the figures. We do have an aging population. People are looking to keep their mortgage debt sooner for a multitude of different reasons. It could be, as I said, the bank of mum and dad raising that money to give to their sons, their grandkids, to support them in what they want to do. It might be they want to keep a debt on their property for the foreseeable future, to maybe assist with inheritance tax planning, or to look after that. Or they might be looking at diversifying their own income streams. They might be looking to invest in some buy-to-lets and things like that as well in the future, and raising that capital, buying that outright, or even with a small mortgage to give them a better quality of life in the future, because the pensions market has changed significantly. There gone are as many of the defined benefit pensions that there used to be, and we're looking at all these other different pension schemes. And this is really where, as an advisor, I'm finding that this is the key time when an advisor really does help their clients through the current situations that we are in. Gone are the days of just being a broker market, of just simply putting the figures in, there you go, off, move forward, we'll worry about it in 2 or 5 years' time when your mortgage is due for renewal. It's now advising them of their circumstances as they stand today, and potentially what they're doing in the future. So, how many of you look at what pension provisions your clients have? Do you understand them? There's so many different schemes out there. Do they have a state pension? When are they going to get it? Do you know where the client can go to get this information up front, such as the government gateway? Do they have a defined benefit or a defined contribution pension? Do they have a SIP? Do they have a SAS? Do you know when they can claim on it, or when they can start drawing it down from? How do they do that? Do they have a wealth advisor that might be dealing with them? Do they have their own employment-based pension? And what if things do go wrong later in life? Rio, as we mentioned there, the main thing that stops some of these cases from proceeding is the death stresses and the additional underwrite that needs to be done, where you are looking at the worst case scenario of what if one of these clients were to pass away. So understanding what would happen if that was to happen will help you guide and educate your customer. And it will be as simple as looking at the pension schemes, pension details, looking through it, and really getting a clear understanding as you, as the advisor, again, as to what their circumstances are. I think you would also be very surprised how many customers that you might deal with that actually don't necessarily understand it themselves as well. And I'm sure they'll be very appreciative of you taking the time to look through it with them and guide them through their circumstances. Now, we're not looking at you being tax advisors or inheritance tax planners or anything like that, but it's just understanding what they've got in the background, and even maybe referring them to a tax advisor or a wealth manager to really plan for that moving forward as well, which I'm sure they'll be appreciative of. Same thing for investments. Now, we're not necessarily just talking about, well, have they got loads of money sitting, have they decided to invest in Apple or Microsoft or anything such as that, but there are a multitude of different investment strategies that are out there, such as company stocks, like we mentioned. They can be looking at investing on the FTSE, or they could be looking at just investing in other large companies within the UK. They might just have a fund that has a spread of different investments within it, which is normally geared towards their risk appetite. They might have ISAs, they might have bonds, they might have a multitude of different things and a few little bits of money dotted away in lots of different places. And understanding again what they are planned for and what that is for, what they can utilize it for later on, is also going to help. Buy-to-lets, again, another form really of a lot of people's retirement planning. They have built up a portfolio of properties. That was their pension. That was what's going to give them an income later on in life when they want to retire, and give them extra money to go on a holiday, or to provide additional income so they can have a new car each year, even when they've retired, and things like that. And it's again understanding the nature of how these are structured and where they are. Well, are they in personal names? Are they being shown on an SA 302? Can you see what their mortgage payments are, if they have any, on those properties as well? What is the structure and their plan long term for them? Is it in a limited company, in an SPV? Are they actually drawing the income from that limited company, or are they, like some of them that we are finding, actually just filtering that money into that company portfolio? They are not needing to draw on that income at this moment in time because they're still working, or they don't need the additional money, and they're just seeing that money actually add in and roll up. Again, depending on the lender that you speak to, that could ultimately become an income stream now or in the future. So if we are looking at an affordability shortfall, then maybe this could be used to top it up. And I've also thrown SASs in there as well, purely because there's a lot of company directors. They do have company pension schemes that they've set up between them, and maybe they bought the building that they are currently in. They're renting it from themselves, or they might be subletting some of the parts of the building to other people, and that's within their pension scheme that is drawing in a rental income, which again helps provide a retirement income later on in life, because chances are when that business retires, they've got two options. They can either sell that property and that cash go into the SAS, or they can just continue to rent it out to a different firm, and that rent can continue later on in life as well. Now, I've added at the bottom here a section for limited company directors. Now, I know we are talking about later life lending here, and normally when you look at this type of thing, limited company directors would lead you to thinking about your standard customers, maybe in their normal kind of ages of life. But what's worth looking at, if you are dealing with limited company directors, are you reading the full accounts, or are you just looking at the SA 302s for their salary and dividend? What you may or may not be aware of when you look through the company accounts is you can scroll through all the different expenses that business has, including the director's salary, including the dividends that are payable. But where you are getting good quality businesses and good quality customers and good quality accountants and tax advisors, more and more you are seeing pensions being put in for the directors. So you might go through the company accounts and you might see a director's pension payment of 25 grand. Now, depending on the lender that you're looking at, depending on what the client's looking at doing, there are two things there. First of all, you know they've got a pension scheme they're paying into. So you can have a conversation with them, say, can I see a copy of that pension? Can I see what's in there? How long have you been contributing to it for? They may have only just started over the last couple of years, but what they might also look at is go, oh, I've been doing this for the last 10, 15, 20 years. And all of a sudden, that pension scheme is potentially going to be utilised for a retirement later on, which again can help you extend a mortgage term past standard retirement ages. Or you might even be able to, depending on the lender, be able to add that pension contribution back in the same way that you might do for an employed customer. So where your client might be looking at a case at the moment, go, oh, unfortunately, the affordability doesn't fit because my salary and dividends or my salary and share of profit doesn't quite fit the affordability models that lender's applying now. As soon as you then add in another 25 grand's worth of potential income, all of a sudden that case fits and can really help you place that case that you thought you might have struggled with in the first place. Also, it will tell you the company structure. It'll tell you the shareholders, it will tell you the directors of that business. And what if your customers that you're dealing with are actually passive directors? What if their sons or daughters are already running that business without really a huge amount of input from your customer, and that accountant is willing to confirm that is the case, then all of a sudden, well, they're not actively involved in that day-to-day running of that business. In fact, it's all running completely without their input whatsoever at this moment. So then that business can be shown to be sustainable without the client's input, which again could potentially lead you to looking at a nice long mortgage term using the business profits or their shareholding and salary, whatever they're drawing from that business, for the next 5, 10, 15, 20 years, up to potentially the age of 95 as an example. So it's that kind of thing where when you're looking at a customer's individual circumstances, if you're not asking the questions, you don't know the answers, and that could potentially cost you and the client a significant amount of money in regards to bad advice or not really looking at what the best option for them is. Okay, so hopefully that understands, that kind of explains to you why education and really getting to grips with this marketplace, I think, is ultimately very, very important. Now, coming on to us as a lender, as we've already mentioned, we do a huge amount of lending in and into retirement. It's one of our mainstays of business. We don't credit score. We look at the credit file and we base an individual assessment on that. We don't believe that really we should be dictated to by a computer to say who we should and shouldn't lend to. Life events happen, and especially when you're dealing with some of the later life customers, they don't always necessarily have a huge amount on credit and a huge amount on finance. And just because they don't score enough points doesn't mean we shouldn't be lending to these customers if they've got the means to maintain and pay this mortgage moving forward. So flexible underwriting as well, we'll look at each case individually, and I'll kind of show you an example of that in a little bit. And us as the BDM team, we have huge relationships with our underwriters. We speak to them on a daily basis, and we can look at a whole amount of different things prior to actually submitting the case, which saves you time and effort, and ultimately hopefully gives you and your customer that little bit of confidence that you discussed the case up front with us before you've even submitted it, to give them that little bit more comfort that things will go through. And when it comes to our criteria, and it falls back really into where the education part here is key, is the vast majority of cases that we do see from high street customers coming to the end of the line with the existing lender, got good income later in life, and the high street is simply saying, no, not interested. Yeah, we'll take your earned income to 70, maybe 75. Oh, but that pension that you're not drawing down at the moment, you know what? No, we don't like that. That state pension that you're going to take in a couple of years' time, oh, we can't consider that. We're only going to take your earned income. Well, that doesn't necessarily, as we mentioned, really fit for everybody. So we will look at owner-occupier repayment mortgage. So standard mortgages, not equity release, just a normal residential mortgage that you would sell on a general day-to-day basis up to the age of 95 at the end of the term. If they've got the income to support it, why wouldn't you? And from our back book and from how we see things being managed in the background of our society, we tend to find this is always managed very well. But if you kind of go back to what we mentioned about COVID, those that had retirement and guaranteed incomes or pensions or investments or SIPs or SASs, they didn't see their job stop straight away. They didn't have to worry about COVID grants, job retention schemes, all these other different things that were thrown at to try and help them survive. They didn't lose their business that they were working for, all of a sudden didn't have to shut up shop and close their doors and they had to find another job. These customers had good quality income and actually could help pay things for the foreseeable. So why not look to consider them? Interest only, another bit of a, it's another one of those where it's fit for the right customers. Interest only, same as equity release, has been kind of covered by a bit of an overall generic badge of whether this be right or wrong. Look at the client's individual circumstances, base it on their individual situation. Does that make sense to them? Is it the right advice? If so, let's look at it. And so we can look up to the age of 89 from when the loan commences for these types of cases as well. Now, when it comes to the earned income, we will look at up to the age of 70. If they're non-manual, we can go to 75, not a problem. Now, where we really kind of look at building the individual scenario to the case is the pension pots, fixed pensions, company salary and dividends. We look at pension funds. If it's a SIP or an investment or anything like that, we look at 90% of that current fund value as it stands today. And then we look at dividing it over the mortgage term that we need to. We again build it around that client's individual circumstances. And where we looked at rental and investments, as we've covered the investment side, but on the rental, if it's on an SA 302 or if it's going into a limited company or it's going into a SAS, that is a passive income that that client can draw on for as long as they need to, or worst case, they can get rid of that investment or asset later on. So another main area for later life lending, especially for things like RIO and for things like equity release, is that might be the right plan for them, but they might need something slightly higher on the loan to value side. We'll go up to 80% loan to value on all cases, whether it be a normal first time buyer, whether it be somebody looking at lending into retirement using their income to support it. So for standard capital and interest mortgages, for standard interest only mortgages, and for standard first time buyer mortgages, 80%, not a problem. And the parents and grandkids, where we mentioned the bank of mum and dad, if we're looking at things like joint borrower sole proprietor, they can again come on to assist with their son or grandchild's mortgage and boost their borrowing up today by utilising their retirement income so that they can getting a nicer, better quality home from day one. So rather than buying a one-bed flat, that could mean them buying a two-bed house. And what that will do long-term is save them from selling that property, paying all the estate agency costs, all the solicitor costs and all that kind of stuff, just to upsize in 2 or 3 years' time. So actually, long term, they are taking a larger debt, but they are saving themselves a significant amount of money by jumping that first hurdle of the ladder of a flat straight to a house. So again, that's the families really helping each other out. Yes, we do offer RIO mortgages for applicants over 55. As we've mentioned earlier, the main kind of caveat to that is we need to look at the worst case scenario of the worst possible income. And really what we end up tending to do is standard interest only. Because again, as I mentioned, we can go up to 80% loan to value with a suitable repayment vehicle in place. Normally that's sale of a buy-to-let or sale of a second home up to 80%. We can consider downsizing as an acceptable repayment vehicle. We will limit that to 70%. But we don't set a minimum equity requirement of that property because, again, each individual client's circumstances are completely different. If you only need £100,000 to downsize to a one-bed retirement flat, that's what equity you will require to downsize. Obviously, different areas of the country are going to be completely different. So, again, we build it around the individual customer. And like some of the areas where, or some of the other lenders where you might find interest only has a kind of a caveat of you need to earn X amount of money. Yes, there is an affordability assessment. We're not just going to look at it and say, well, we'll lend you loads and loads and loads of money because it's on interest only. It will have an affordability assessment on it. And if they can afford it, they can have it. And we will do an interest only stress on a mortgage term of 10 years or less. So that gives your client that little bit more comfort that in 10 years, for the next 10 years, their mortgage is protected. They can continue on an interest only basis without too much of a problem. Okay. Now, what I wanted to look at here is we've gone through quite a bit of information, and I just wanted to kind of bring some of it to life of a customer where they've got a few different incomes moving on into their later life. They've got a state pension currently at 10,600. They do have a buy-to-let property in the background that's worth 250,000, which is giving them just over 9.5 grand's worth of rental income that can be evidenced via an SA 302. Now, where we tend to get the majority of the cases and where we can be very, very flexible is if I come onto the SIP value. So I know I've got SIP there, but it would be the same as if the client had an investment vehicle. So if they've got stocks or shares or investments or anything like that, it would be exactly the same. But based on this kind, I've just covered it down as a SIPP. We look at the fund value and we take 90% of that. So that gives you a usable fund value of £270,000. What we then do is we then divide that over the mortgage term that client is looking to do. So if they wanted a 20-year mortgage term, we'd divide that by 20, gives a usable income of £13,500 a year. Now that might be perfectly fine for what they need to do and to kind of get the level of borrowing that they need, and that's all fine. What they might actually want to do is actually, you know what, I might need that a little bit more, or we might need to change that kind of affordability model ever so slightly to get them to the goals they want to do. They might want to give more money to the kids or grandkids and really boost their own circumstances. So what they might want to do is say, well, I don't want to do it over 20 years. I'm quite happy to do it over 10 years. Then we divide that same fund by 10. So as you can see, just by looking at that customer and by just looking at their circumstances in a different way, you've got a significant amount of difference when it comes to the actual mortgage, the actual income that we can use to support that mortgage. Now, again, they might not need 47 grand's worth of income. They might only need 33. So in that case, we just extend the term again. And they can borrow that money over a longer period of time, making their monthly payments cheaper. Or, as we've mentioned earlier, it could be a joint borrower sole proprietor where they might be assisting their sons, daughters, grandkids, and actually a 20-year term might be more beneficial for them because they want to kind of have their mortgage term over as long as possible as well. And on top of that, that buy-to-let property can be utilised as either a part of an exit for an interest-only case, or that could be the exit. They could sell their main residence and move into their unencumbered buy-to-let. That client's individual circumstances can be looked at a multitude of different ways. And we as the BDM team are always happy to run through these types of cases and scenarios to really help you provide the best possible advice to your customers. So hopefully that gives you a little bit of a flavour of us as a lender and the challenges that you found within the market, and then the understanding of why this area of the market is becoming more and more important to more and more people's business, and a clearer understanding of how you can help. Any questions? I'll pass you back to Nick.
Yeah, thank you very much, Darren. Thank you very much, Nathan. That was a great presentation. I think really informative, very chunky. I think the viewers have got a lot out of it. Now, we have got a few questions through, but obviously, please keep sending any more as you come through. I think there's probably a lot of questions to come through from that. So, first question that we have actually for Darren and Nathan is simple one, really. I'm not sure it's that simple, but do you accept mortgage prisoners?
I'll jump on that one just quickly. So yes, when it comes to mortgage prisoners, it depends on what people are looking at and what they would deem as a mortgage prisoner. More and more people now are in that circumstance where the lender said, yes, we will lend to you up to maybe 70 as a guide. And when they've got to that age, they've gone, oh, well, I can still afford my mortgage, but you're saying no. We'll look at those. We'll base it on the individual client circumstances and really kind of build that case around them where they might have the pensions and the investments and the income. Also, affordability is that little bit tighter, and that client might be able to demonstrate they've maintained that mortgage for a long period of time. And actually, although the affordability model may say they can't quite afford it, it might only be an ever so slight stretch on their income to actually say, yes, they can do it. So yeah, we can look at those, and we're always happy as the BDM team to consider those. And we'll say what the existing lender might class as a mortgage prisoner, we might turn around and go, actually, that's just our day to day. That's just what we do. So yeah, talk to us about it, and let's see what we can look at.
Interesting. Let's see. We've actually got some more questions coming through now as well. So I'll just quickly grab one of those. So we've also been asked, or we'll ask you guys, how many applicants or incomes do you or can you consider?
I'll take that one, Nick. I don't know if I'm having problems with my microphone. Let me know if it's coming through that way. Yeah, we can take four. Okay, we can take 4 applicants and 4 incomes. So it can come in a variety of different scenarios. So we do lots of joint borrower sole proprietor, whereby parents and grandparents can assist their children or grandchildren. And obviously that's where we come into play because of the later life, because we can lend to age 95. And in general, just as a standard mortgage, so it doesn't have to be a joint borrower sole proprietor. You could have 4 adults, so their parents and their older working age children on the mortgage, living in the property. And yes, we could take all 4 applicants and all 4 incomes.
Excellent. Can I just ask a question on the back of that? Actually, we do have some more, but it's a very quick one. Do you find that your customers and people who come to you, do they actually know about sort of the JBSP mortgages? Do they have that kind of education, or is there sort of more needed on that, do you think?
Well, I think as a product, it certainly has gained momentum from when it was first talked about, I don't know, maybe 4 to 5 years ago, and it certainly has evolved. But as with everything, there's more education that's needed. I mean, as I just said there, the fact that we can go deeper into retirement over and above certainly many of the high street lenders puts us at an advantage when we're looking at those mortgages where they're bringing on a parent who might be into their 50s and 60s, and in most cases they are, and their terms can be restricted. You know, maybe that high street lender will take on that joint borrower sole proprietor, but you might only get a term to age 70, 75, 80 even. But as I say, we can go far beyond that. I mean, funny, I did see something today. I think the Skipton are now calling it the income booster mortgage, which essentially is the same. Whether it's rebranding it once again, but all in all, the joint borrower sole proprietor, it's there when we look at those situations where, you know, to say the first time buyer, typically, you know, they're nearly there to get that mortgage, and that's where the broker can then just ask those additional questions to see, look, they can't quite afford where they need to be. Can they bring a parent or a grandparent or a wider family member even onto that mortgage to make it more affordable?
Yeah, and I think kind of jumping on the back of that a little bit is part of it is the market changing as well, where house prices have gone up, maybe as we've seen with a lot of companies and a lot of businesses, and we've seen a lot of strikes of it where the incomes haven't kept up with everything else that's been going higher and higher and higher, and also people's circumstances change. They might decide actually people have separated and actually want to keep a property and they can't afford it on their own because they took a joint 4.5 times income mortgage out at that point, and they've lost half or a third or 2/3 of that income stream, and they want to stay there. The parents before might have turned around and said, well, we can't really do anything to help, but or if they did, stamp duty might have been the main crippling factor because it's a big bill when you add the extra 3% surcharge on it, and they go, actually, you know what, this might be the right solution, saves them a couple of quid on tax bill, and also helps their son, daughter and things keeping that property. The other thing, we find it the other way around. So some of the older clients that have their incomes have changed and unfortunately wouldn't pass things like a mortgage prisoner side of things, where they might feel their only option is an equity release, or their LTV is too high on that, or they're too young to do it. The kids are coming on and helping the parents to keep them in their home as well. So it does go both ways.
Interesting. Yeah. Well, another couple, and actually a question related to that, and being asked. So, can a joint borrower sole proprietor be in the name of parent, child, and child's partner? And the viewer actually very asked a nice please as well, so they really want to know the answer. So so can joint borrower sole proprietor be in the name of parent, child, and child's partner?
Yeah. So So yeah, we can look at each case is individual. Everyone's circumstances are different. The main thing that we are looking for, generally speaking, is those that are living in the property. Generally speaking, are the ones that are on the mortgage and the title, because ultimately it's their property, it's where they're going to be living, and then they're assisted with somebody else who's living elsewhere, and they're the people that don't want to go on the title but also want to be named on the mortgage. So that's generally how you see things. So a three-way mortgage such as that is perfectly fine. Ultimately, it depends on the client's circumstances, and we're always happy to have a chat about it.
Okay. This is a pretty lengthy and specific question, but I will. I hope you guys can answer it. You are the experts after all. So we've been asked: is there an appetite to go outside the maximum loan advised by the calculator if it is a pound for pound remortgage and current payments are higher than the new payments will be, and there's no evidence of issues making? They can evidence there are no issues making current payments. So I can either repeat that, or if you're good with it, please. I think we need an answer.
Do you want me to jump on that there? So it falls onto what we were saying about the mortgage prisoner side of things. So again, there is the appetite to look at it. If we can see, if we can get a proven track issue, so lenders might be sitting on the SVR, and that SVR can range from 5, 6 to 9%, depending on the lender and depending on what they had beforehand. So going outside a standard affordability model is we are regulated. There are elements of things that we have to look at, and if we do things outside of standard policy, we do need to report that, and then the regulator does need to come in and have a look and just from time to time and make sure that we're not taking too many risks. But that kind of scenario where you can demonstrate it, we can look at the case as a whole and look at it and say, well, the affordability is there or thereabouts. They haven't been eating into loads and loads of savings. They haven't been paying, they haven't gone from 10 grand in credit to 2 grand overdrawn on their bank account. Nothing is financially distressed. And actually, if we were to look at it on an affordability model based on the monthly payments that our mortgage would take and it passes, then yes, we might be able to look at it. Again, this is really where from us, we look at it on a manual basis and try and see if we can build it. And again, sometimes there might be other options where we may not need to go down that route because they might have something else in the background that might all of a sudden help things out. They might only have in my example, I talked about somebody with a £300,000 pension fund, which is quite a lot of money. Not everyone's necessarily got that. They might only have 50 grand. But what that might do is that 50 grand, which they go, oh, that's nothing, I don't need it. Well, we can use that today, add that in and maybe do a 10-year interest-only mortgage. That's an extra 4 or 5 grand's worth of income. And then all of a sudden that fits and you're not a mortgage prisoner. As long as you're old enough to be able to draw on it, over 55, for example, for SIPs and things like that, let's use it and add it in today. And then then the client's getting the right mortgage with the right advice and without necessarily needing to go down an exception route. But yes, we can have a look at them anyway. So always happy to look at.
Excellent. Okay, we are sort of approaching fairly near the closing time, but I think we've probably got a little time for another couple of questions that we've been asked. So if you guys can just stay on, that would be great. Because I think we'd like to get these questions answered. So, do your interest-only mortgages have to be affordable by each person on the mortgage? We've been asked here.
Essentially, no. It's what I described earlier when we were talking about a REO mortgage. So, as I said in one of the slides, a REO mortgage has to have what we commonly call the death stress, and that is if one person were to pass away, meaning that the person that remains, they need to demonstrate affordability for that total mortgage. Often that's the problem. You do need joint borrowing or joint incomes, and things such as pension transfers. Whilst there might be some, there's not an automatic, and it might not be to the full value. So that's where a lot of these drop away. But then they will fall into just a standard interest-only mortgage, which is what Nathan was talking about there. So yes, we can go to 80% or 70%, depending on whether what repayment vehicle there are, But to answer the question, no, we just need to see that it's affordable as the application is presented to us at that time. And with the fact that we do have long open-ended, fixed-ended, but long terms that we can offer for interest only, it tends to do the trick. But no, we don't need to demonstrate affordability in sole names. That's an advantage.
Brilliant. Okay, right. We have got another interest-only question as well. So I'm just going to put that on as the last one because obviously we've got running over time a little bit, but all good. So, will you do a pure interest-only calculation for affordability? We've been asked here. Nathan, sorry, just going to take.
Yeah, seen it. Just on mute. Apologies. You think after a couple of years of COVID and things like this, we'd be used to it by now.
Yeah, I do it all the
time. So yes, we can look at for terms of 10 years or less, we will base it on an interest-only style stress. We'll still look. There's still obviously mentions of affordability caps and things like that, because you'll need to be mindful that we're not putting that client into 100 times their income or anything crazy like that. But what you are looking at is 10 years or less, we will apply a more generous calculation. Anything 10 years or more will be deemed, for us anyway, as the same way as a normal capital and interest mortgage. So what you tend to find is if somebody wants maybe 12, 13 years on interest only, chances are they're going to get a significantly better result by looking at a 10-year. And what that really does as well is it builds in a review for that client and their circumstances, purely because if you go back quite a few years, lots of people had interest only mortgages. They are coming to fruition now. They may have paid off the endowment or cashed it in, and that might be the car that's on the driveway. Or they may have just said, I don't need to worry about it. Don't need to worry about the mortgage for a while. I'll worry about that later on. And now they're in that scenario where they can't do anything. So by doing things like a 10-year interest only stress, they can get the money they need and just have to review it on a more regular basis to just make sure it's still kind of right for their needs and suitable for them, which kind of falls in quite nicely with things like consumer duty now, where you really need to make sure that you are overseeing the client's circumstances and this is the right thing for them to do now and in the future.
Okay, gentlemen, right, we are going to wrap it up there, but we do have a fair number of questions again that have come through that perhaps we'll be able to put to you later on, and then perhaps in because obviously there's a lot of people watching this and a lot of people have really enjoyed it. There's a lot of questions coming through, as I said, so we may well in the future ask you the questions that have come to us, and maybe we'll put something up in Mortgage Solutions in the future to give people the answers they want. But obviously a fascinating discussion which a lot of people have engaged with, and excellent presentation. So thank you very much for everyone who has viewed it. We will also put the recording up on Mortgage Solutions as well. So again, thank you very much, and thank you, Darren, and thank you, Nathan, and have a good day.